Welcome to Session 1, Understanding Financial Statements. The outline of the session is given here. Contents of the annual report, accounting information system and accounting principles, accounting model, contents of financial statements such as balance sheet, statement of profit and loss and cash flow statement, accounting policies and practices in India, managing the bottom line, ethics in finance, and integrated reporting. Shareholders, lenders, managers, customers, vendors, tax authorities and regulators are interested in knowing at least three important things about a business. What is the financial position of the firm at a given point of time? How well has the firm performed over a period of time? What have been the cash flows of the firm? In order to answer these three important questions, the accountant prepares three statements: balance sheet, statement of profit and loss, and cash flow statement. The balance sheet shows the assets, liabilities, and owner's equity at a given point of time. The statement of profit and loss shows revenues, expenses, and the net results of operations. The cash flow statement shows cash flows from operating activities, investing activities, and financing activities. In addition, a supplementary statement called the statement of changes in equity is prepared, which shows net profit, dividend, return of capital, and other transactions. There are many different kinds of users of financial statements: investors, analysts, advisors, lenders, managers and directors, employees, trade unions, suppliers, trade financiers, customers, auditors, government, regulatory authorities, and the public at large. Contents of the annual report. The annual report is the most important report prepared by a firm, a comprehensive document. It has a lot of information. The important sections of the annual report are director's report, financial statements, auditor's report, management discussion and analysis, other statutory report. Director's report provides information on financial performance, recommends dividends, provides information on appointment of directors, auditors, cost auditors, and also has some other information. Financial statements consist of the balance sheet, the statement of profit and loss, the cash flow statement, and the statement of changes in equity. Financial statements are prepared on a standalone basis as well as a consolidated basis. Financial statements are supported by notes to financial statements which provide technical details. Financial statements along with notes to financial statements form the core of the annual report or heart of the annual report and often occupy the bulk of the annual report. The financial statements found in the annual report are meant for financial reporting. Financial reporting is distinct from tax reporting. Tax reporting is meant for tax authorities. Tax reporting is not in public domain. Financial reporting is in public domain. Auditor's report is given by an independent chart accountant who provides an opinion about the financial statements of the firm. The auditor states whether the financial statements of the firm represents a true and fair view of the financial affairs of the firm. Management discussion and analysis provides information about industry structure, industry prospects, strategy followed by the firm, risk exposure of firm, risk management policy of the firm, and so on. Other statutory reports include Business Responsibility Report, Corporate Social Responsibility Report, Corporate Governance Report, and Secretarial Audit Report. Some of the leading companies are now providing integrated annual report in conformity with the guidelines provided by the International Integrated Reporting Council. Here is a pictorial representation of the accounting information system. The accounting information system processes business transactions and external events using a set of accounting principles, accounting standards, accounting policies, and management assumptions and estimates. The output of the accounting system is a set of financial statements, balance sheet, statement of profit and loss, cash flow statement, and statement of changes in equity. The outputs of the accounting information system are of relevance to a large number of users. Accounting is a highly technical discipline. Preparation of financial statements is the responsibility of professionally qualified accountants. If we look at the accounting framework, we find that it has four broad elements: principles and conventions, accounting standards, accounting policies, manual estimates and judgments. Principles and conventions are the foundation on which the entire edifice of accounting is constructed. There are 8 to 12 important principles and conventions. On the foundations of principles and conventions, an elaborate structure of accounting standards rests. Accounting standards are defined by professional bodies and regulatory agencies. Indian accounting standards, for example, are over 750 pages. Accounting standards define the boundaries within which firms can choose accounting policies. Accounting policies are specific policies followed by the management of a firm within the framework defined by accounting standards. To implement accounting policies, manual estimates and judgments are required. So we find that financial statements, as we see, are based on a very comprehensive framework. The important accounting principles are entity principle, going concern principle, money measurement principle, dual aspect principle, realization principle, matching principle, accrual principle, historical cost principle, and conservatism principle. A word about each of them. Entity principle says that the firm should be regarded as a separate entity distinct from the owner. Going concern principles views the firm as an ongoing entity, an entity with an indefinite life and not an entity which is likely to be terminated in near future. Money measurement principle says record only those transactions which can be measured in monetary terms. Dual aspect principle, the most foundational principle of accounting, says assets are always equal to equity and liabilities. Realization principle says that revenue should be recognized when it is earned, not when it is received in cash. Matching principle says expenses should be matched to revenues and not vice versa. Accrual principle, also called the mercantile principle, says that revenues are recognized when they are earned, not when they are received in cash. Likewise, expenses are recognized when they are incurred, not when they are paid for in cash. Historical principle says record assets and liabilities at their historical values. Of course, now there is a modification to this principle called the fair value accounting principle. Conservatism principle says anticipate all possible losses but do not provide for possible gains. Accounting by nature is very conservative. The foundation principles of accounting may be represented in terms of a diagram like this for better understanding. We talked about accounting being done for a business firm which is treated as a separate, distinct entity. What are the kinds of business entities or business organizations? The most important kinds of business organization are proprietorship, partnership, and company. Let us compare these three forms of organization on various dimensions. Ease of starting, instant, some time, more time. Decision making, very flexible, fairly flexible, constrained. Raising capital, difficult, somewhat easy. Legal compliance, easy, fairly easy, burdensome. Owner's liability, unlimited, limited. Suitability, small business, mid-sized business, large-sized business. The dual aspect principle is the most fundamental principle of accounting. According to this principle, Economic resources of the firm are equal to claims on these resources. Economic resources are the assets owned by the firm. Claims on these resources are liabilities and equity. How does the accounting model, founded on the dual aspect principle, process business transactions? To understand how the accounting model works, we will look at an illustration. Ram Enterprises has been set up by Mr. Ram. So Ram Enterprises is the business entity for which we are doing accounting. Transaction 1, Ram contributes rupees 500,000 as equity capital, which is deposited in a bank account opened in the name of Ram Enterprises, a proprietary business firm. At the end of this transaction, on the asset side, there is a bank deposit of 500,000. On the liabilities and equity side, there is a share capital of rupees 500,000. This represents the contribution of RAM to the firm, and it is held in share capital account. The total of the balance sheet is 500,000 as shown here. Transaction 2, Ram Enterprises pays rupees 100,000 as deposit for hiring office premises. We will call this as premise deposit. As a result of this transaction, bank deposit reduces by 100,000. Premise deposit comes into being. It is a new asset. It is worth 100,000. Share capital remains at 500,000. The balance sheet total remains at 500,000. Transaction 3, Ram Enterprises buys furniture and fixtures for rupees 300,000. When furnitures and fixtures are bought for rupees 300,000 in cash, bank deposit reduces from 400,000 to 100,000. Other items remain unchanged. A new asset called furnitures and fixtures comes into being. The total of the balance sheet remains at rupees 500,000. Transaction 4, Ram Enterprises buys merchandise worth rupees 300,000 on credit. When Ram Enterprises buys merchandise worth rupees 300,000, a new asset called merchandise worth rupees 300,000 comes on the balance sheet on the asset side. On the liability side, a liability called trade credit of 300,000 is created because the merchandise is bought on credit. As a result of this transaction, the size of the balance sheet expands from rupees 500,000 to rupees 800,000. Transaction 5, Ram Enterprises sells merchandise costing rupees 100,000 for rupees 120,000 in cash. When this transaction takes place, merchandise balance diminishes from rupees 300,000 to rupees 200,000. Bank deposit increases from rupees 100,000 to rupees 220,000. This transaction has generated a profit of rupees 20,000, which has been plowed back in the business. This is shown under reserves and surplus. An amount of rupees 20,000 reserves and surplus means that a profit of rupees 20,000 has been generated and retained in the business. This is part of owner's equity. It is as if Ram Enterprises is telling Mr. Ram, you have created me, I have generated a profit of rupees 20,000 on this transaction. This profit really belongs to you, so I am acknowledging that I have a higher level of indebtedness toward you, or you have a higher claim on me. So the claim of Mr. Ram after this transaction would be the sum of initial capital plus reserves and surplus. As a result of this transaction, the balance sheet size grows to rupees 820,000. Transaction 6, Ram Enterprises sells merchandise costing rupees 80,000 for rupees 100,000 on credit. When this transaction takes place, merchandise balance diminishes from rupees 200,000 to rupees 120,000. A debtor of rupees 100,000 comes into being. This transaction also produces a profit of 20,000, and this is plowed back in the business. So reserves and surplus is augmented from rupees 20,000 to rupees 40,000. After this transaction, the balance sheet looks like this. Total assets rupees 840,000, total of liabilities and equity rupees 840,000. Transaction 7, Ram Enterprises pays establishment expenses of rupees 5,000 cash. When these expenses are paid, bank deposit reduces from 220,000 to 215,000. Reserves and surplus decline from rupees 40,000 to 35,000. Revenues augment reserves and surpluses. Expenses diminish reserves and surpluses. You can imagine a conversation like this between Ram Enterprises and Ram. Ram Enterprises is telling Mr. Ram, you have created me. I have incurred an expense or loss of 5,000 on account of this transaction. So you have to bear that. So I am reducing your claim on me from rupees 540,000 to 535,000. Transaction 8, Ram Enterprises pays rupees 9,000 as rent in cash. This rental payment will diminish bank deposit by 9,000. On the reserves and surplus account, there is a reduction of 9,000. Remember, every expense reduces reserves and surplus, and every revenue augments reserves and surplus. So the balance sheet balances after this transaction. Transaction 9, Ram Enterprise depreciates its furniture and fixtures by 10,000. As a result, the balance in the furniture and fixtures account is reduced from 300,000 to 290,000. Since depreciation is an expense, though a non-cash expense, it reduces reserves and surplus by 10,000. So the balance sheet after this transaction has a total of 816,000. When we compare the beginning balance sheet with the balance sheet after all the transactions, we find that reserves and surplus, which was nil to start with, grew to 16,000 after a series of transactions. This means that the transactions cumulatively produced a profit of 16,000. Statement of profit and loss account gives us details of revenues and expenses which have led to a profit of rupees 16,000. Revenues have been rupees 220,000, 120,000 in cash, 100,000 in credit. Expenses have been 204,000, broken down in this manner. So the statement of profit and loss account, which is strictly speaking an adjunct to the balance sheet, provides a lot of useful details relevant for managers. Let us summarize the basic rules of accounting that we have followed in processing various transactions. Rule 1. Every transaction has a bearing on at least two accounts in the balance sheet. Rule 2. Irrespective of what the transaction is, the equation assets are equal to liabilities plus equity is always satisfied. Equity comprises of two items, equity capital and reserves and surplus, which are also referred to as other equity. Rule 3. Transactions which generate revenues and or entail expenses have a bearing on reserves and surplus or other equity. Transactions which generate revenues augment reserves and surplus. Transactions which entail expenses diminish reserves and surplus. Rule 4. The profit and loss account provides the details of revenues and expenses. Strictly speaking, it is a technical adjunct to the balance sheet, but it is a very valuable statement in terms of providing useful information. Thus, we find that accounting is as simple as 1, 2, 3, and 4. The fundamental accounting model that we have employed for processing transactions is assets are equal to liabilities plus owner's equity. However, we also learned that the owner's equity increases by investments and revenues but decreases by withdrawals and expenses. Hence, the fundamental accounting model may be expanded as follows. Assets are equal to liabilities plus owner's equity. Owner's equity increases with capital contributions and revenues and decreases by withdrawals and expenses. This model facilitates the recording of the dual effect of each transaction. For pedagogic purposes, we recorded 9 transactions of RAM Enterprises on a series of 9 balance sheets. A more efficient way of recording transactions in terms of the accounting model is shown in this table. 1. RAM contributed rupees 500,000 as equity capital. Bank deposit and asset increases by 500,000. Equity increases by 500,000. 2. Premise deposit of rupees 100,000 paid. Bank deposit decreases by 100,000. Premise deposit, another asset account, increases by 100,000. 3. Furnitures and fixtures bought for rupees 300,000. Bank deposit decreases by 300,000. Furnitures and fixtures and asset account increases by 300,000. 4. Bought merchandise for rupees 300,000 on credit. Merchandise, another asset account, increases by 300,000. Trade credit, a liability account, increases by 300,000. 5. Sold merchandise worth rupees 100,000 for 120,000 cash. Merchandise decreases by 100,000. Bank deposit increases by 120,000. Reserves and surplus, which is part of owner's equity, increases by 200,000. 6. Sold merchandise costing rupees 80,000 for rupees 100,000 on credit. Merchandise declines by 80,000. Debtors, a new asset, increases by 100,000. Reserves and surplus increase by 20,000. 7. Paid establishment expenses in cash. Bank deposit decreases by 5,000. Reserves and surplus decrease by 5,000. 8. Paid rupees 9,000 as rent. Bank deposit decreases by 9,000. Reserves and surplus decrease by 9,000. 9. Depreciated furnitures and fixtures by rupees 10,000. Furnitures and fixtures decrease by 10,000. Reserves and surplus decrease by 10,000. For pedagogic purposes, we prepared a set of 9 balance sheets, one after each transaction. A more efficient way of recording transactions in terms of the accounting model is shown in this table, where the impact of these 9 transactions on assets, liabilities, and equity is shown. 1. RAM contributed rupees 500,000 as equity capital. Bank deposit and asset account increases by 500,000. Equity increases by 500,000. 2. Premise deposit of rupees 100,000 is paid. Bank deposit decreases by 100,000. Premise deposit and asset account increases by 100,000. 3. Furnitures and fixtures bought for rupees 300,000. Bank deposit decreases by 300,000. Furnitures and fixtures, another asset account, increases by 300,000. 4. Bought merchandise for rupees 300,000 on credit. Merchandise and asset account increases by 300,000. Trade credit, a liability account, increases by 300,000. 5. Sold merchandise worth rupees 100,000 for rupees 120,000 in cash. Merchandise decreases by 100,000. Bank deposit increases by 120,000. Reserves and surplus, which is part of equity, increases by 20,000. This represents the profit on this transaction. 6. Sold merchandise costing rupees 80,000 for rupees 100,000 on credit. Merchandise decreases by 80,000. Debtors and asset account increases by 100,000. This transaction also produces a profit of 20,000. So reserves and surplus increase by 20,000. 7. Paid establishment expenses in cash. Bank deposit decreases by 5,000. Reserves and surplus decrease by 5,000. 8. Paid rupees 9,000 as rent. Bank deposit decreases by 9,000. Reserves and surplus decrease by 9,000. 9. Depreciated furnitures and fixtures by rupees 10,000. Furnitures and fixtures decrease by 10,000. Reserves and surplus decrease by 10,000. Handling data processing problems. Recording transactions as we have done in the above exhibit may pose 2 problems. 1. it is difficult to keep track of the amount of each kind of asset, liability, and owner's equity. 2. There is scope for making errors in recording the increases and decreases in various accounts. To cope with these problems, we require an efficient method for keeping track of the amount of each kind of asset, liability, and owner's equity, and a systematic approach for recording the increases and decreases in them. For these purposes, accountants have developed the device of account and a system of debits and credits. An account represents a standardized arrangement for recording data. In a typical accounting system, there exists a separate account for each asset, such as land, building, equipment, inventory, cash, each liability, such as notes payable, creditors, each category of owner's equity, such as share capital, general reserve, investment allowance reserve, each item of revenue, and each item of expense. Every account has two sides, the debit side and the credit side. In the arrangement known as the T account format, the left side is the debit side and the right side is the credit side. The bank account of RAM Enterprises in T account format is shown here. In this account, on the left or debit side, increases are shown. On the right or credit side, decreases are shown. The bank account increases due to capital contribution by the owner and due to cash sales of 120,000. So the total increases are 620,000. The bank account decreases on account of payment of premise deposit 100,000, purchase of furnitures and fixtures 300,000, payment of establishment expenses 5,000, rent payment 9,000. Total decreases are 414,000. At the end of all of these transactions, the net balance is 206,000. When I was teaching a course on financial accounting to students at XLRI, they had some difficulty in understanding the concepts of debit and credit. So I coined a phrase, debit the receiver, credit the giver. Look at any transaction, ask who the receiver is and debit the receiver and ask who the giver is and credit the giver. If we look at the bank account, we find that it is receiving benefits on account of contribution made by the owner and on account of cash sales. So we debit the bank account. Whereas in these cases, the bank account is the giver, so we credit the bank account. The system of debits and credits, a fundamental accounting model, and the T account were designed and developed by Peccoli, the father of accounting, several centuries back. Interestingly, he was an Italian monk. For systematic recording of increases and decreases in accounts, he added another algebraic balance feature, assets equal to liabilities plus owner's equity. Increases in assets are shown on the debit side, decreases in assets are shown on the credit side. We have seen in the asset account bank deposit that debits are shown on the left side and credits are shown on the right side. As far as liabilities and owner's equities are concerned, increases are shown on the credit side and decreases are shown on the debit side. Thanks to the addition of this balance feature, we have the rules: debits are always equal to credits and assets are always equal to liabilities and owners' equities. Thus, increases and decreases in assets, liabilities, and owners' equity are shown here. From this, it is clear that the owner's equity is increased by credits and decreased by debits. Since revenues increase owner's equity and expenses decrease owner's equity, we get the following rules. Revenues are recorded as credits, expenses are recorded as debits. So far, we looked at processing transactions directly on the balance sheet. The thrust of our discussion was on understanding the accounting model and the basic accounting rules. In the real world, the accounting information processing cycle is fairly elaborate. It consists of several steps: collection of raw data relating to business transactions in the form of sales invoices, purchase invoices, material issuances, and so on. Analysis of transactions, this is a mental process which determines the effect of transactions on various accounts. Recording in journal, the journal is an accounting record which lists chronologically business transactions and also states its impact on various accounts in terms of debits or credits. Posting to the ledger, a ledger represents a group of accounts in the form of a bound book or loose leaf pages or electronic form. Transactions from the journal are posted to the ledger. Preparation of trial balance. A trial balance is a listing of the ledger accounts along with their net debit or credit balances. It serves two functions. It checks the equality of debits and credits. It arranges data in a convenient form for preparing financial statements. Passing of adjustment entries to reflect economic events related to the period but not recorded earlier. These events may be accruals, depreciation, and so on. Preparation of financial statements. After making adjustments, a modified trial balance is prepared, and this forms the basis for preparing financial statements. All revenues and expenses are taken to the profit and loss account. This may be viewed as a clearing account through which the impact of revenues and expenses is transmitted to owner's equity. All asset, liability, and owner's equity balances are finally shown on the balance sheet. To sum up, the steps involved in the accounting information processing cycle are collection of raw data, analysis of transactions, recording of transactions in the journal, transfer of information to the ledger, preparation of trial balance, passing of adjustment entries, preparation of financial statements. The balance sheet of a company in India has to be prepared in conformity with the format given in the Companies Act. Here is an illustrative balance sheet. This balance sheet of Horizon Limited as at 31st March 20X1 is drawn from the book Finance Sense. In the balance sheet, we have figures for the current year as well as the previous year. The three major categories of items under equity and liabilities are shareholders' funds, non-current liabilities, and current liabilities. Shareholders' funds, also referred to as net worth, consists of share capital, which includes equity capital and preference capital, plus reserves and surplus, which is also referred to as other equity. Non-current liabilities are liabilities which are expected to mature after 1 year. The important items under non-current liabilities are long-term borrowings from banks and financial institutions. Deferred tax liabilities are liabilities which are due to tax authorities in future. Other long-term liabilities, long-term provisions are provisions for employee benefits, etc. Current liabilities are liabilities which are expected to mature in the next 12 months. The important items here are short-term borrowings from banks, financial institutions, and other sources. Trade payables are dues to suppliers and vendors who have provided credit to the firm. Other current liabilities may be accrued wages and so on. Short-term provisions may be short-term provisions for certain bad debts and so on. The assets of the firm are divided into two broad categories: non-current assets and current assets. Non-current assets are assets which have an economic life of more than 1 year. The key items here are fixed assets, non-current investments, and long-term loans and advances. Fixed assets include tangible fixed assets such as land, building, plant, and machinery, and intangible fixed assets such as goodwill. Non-current investments are long-term investments made in subsidiaries, associate companies, joint ventures, and so on. Long-term loans and advances are loans and advances given to other organizations which have a maturity of more than 1 year. Current assets are assets which have an economic life of less than 1 year. The key items here are current investments, inventories, trade receivables, cash and cash equivalents, short-term loans and advances. Current investments are investments which are expected to mature in the next 12 months. Inventories include raw material inventory, work in process inventory, and finished goods inventories. Trade receivables are receivables on account of trade credit extended by the firm to its customers. Cash and cash equivalents include cash, bank deposit, and investments in liquid schemes of mutual funds. Short-term loans and advances are loans and advances given to other firms. Let us look at the statement of profit and loss for Horizon Limited. This statement is shown for the year ending 31st March 2001. We have the figures for the current period and the previous period. This statement starts with revenues from operations. These are revenues derived from the sale of goods and services which are part of the normal operation of the firm. Other income may consist of items like interest and dividend income. Total revenue is 1300 million. Under expenses, we have material expenses, which often represent the most significant expense for manufacturing firms, employee benefit expenses, finance costs like interest costs, bank charges, and so on. Depreciation, which represents write-off of tangible fixed assets, and amortization, which represents write-off of intangible fixed assets. Other expenses like selling and general administration expenses, and also research and development expenses. Total expenses 1120 million. When we subtract total expenses from total revenues, we get profit before exceptional items and tax of 180 million. Exceptional items are items which are non-recurring nature, such as gain derived from sale of plant and machinery or an exceptional bad debt charge. In this case, there is no exceptional item. Profit before tax is 180 million. Tax expenses 50 million. Profit for the period is 130 million. This is divided by the number of outstanding equity shares to derive earnings per equity share. Basic earnings per equity share represents profit after tax divided by number of outstanding shares. Diluted equity earnings per share represents profit after tax divided by number of outstanding shares plus potential shares that may be issued when options are exercised. Dividends represent payment of dividend to equity shareholders and preference shareholders. Consider the following questions. Why some profitable firms are not able to pay their suppliers promptly? How does Tata Steel pay for its big ticket acquisitions? Why did Berkshire Hathaway hold cash of $140 billion as on December 31, 2019? How does a company stay afloat and expand despite incurring losses? Answers to the above questions are not found on a company's balance sheet or statement of profit and loss account. The balance sheet shows information on assets and how they are financed. Statement of profit and loss shows information on the company's performance and earnings as measured by accrual accounting. Beyond these two statements is the statement of cash flows. The statement of cash flows, now a standard feature of financial reporting, provides information on cash receipts and payments and answers the kinds of questions that we raised earlier. The statement of cash flows is divided into three segments: cash flow from operations, cash flow from investing activities, cash flow from financing activities. Cash flow from operations are cash flows generated from the operating activities of the firm. Cash inflows from operations minus cash outflows from operations. Cash flows from investing are cash flows generated by the investing activities of the firm. Cash inflows from investing activities minus cash outflows from investing activities. Cash flow from financing activities represent cash flow from the financing activities of the firm. Cash inflows from financing activities minus cash outflows from financing activities. The sum of these three represent the net cash flow for the period. Let us As we have seen, the first segment of the cash flow statement shows cash flow from operating activities. We begin with profit before tax, which is 180 million. Make adjustments for certain items. Depreciation and amortization of rupees 50 million is added back because this represents a non-cash expense. Finance costs of 30 million are added back because this represents an item that belongs to financing activity. Interest income of 10 million is deducted because it relates to investment activity. After these adjustments, we get operating profit before working capital changes. We make adjustments for changes in working capital. Trade receivables have increased by 20 million, inventories have increased by 20 million, and trade payables have increased by 20 million. Trade receivables and inventories, when they increase, absorb operating cash flow. Trade payables, when it increases, provides operating cash flow. So these are deducted and this is added. After doing these adjustments, we get cash generated from operations, which is 240 million. Direct taxes paid are 50 million. So net cash from operating activities is 190 million. The second segment looks at cash flow from investing. Purchase of fixed assets during the year is 100 million. Increase of not current assets during the year is 10 million. Reduction in long-term loans and advances is 10. Interest income is 10. When we add all of these, we get a negative 90 million as net cash used in investing. Finally, we look at cash flow from financing. There is 20 million of increase in long-term borrowings, 10 million of increase in short-term borrowing. Then there is a payment of 80 million by way of dividend and payment of finance cost of 30 million. Hence, the net cash from my financing is minus 80 million. If we add A, B and C, we get a figure of 10 million. The beginning cash and cash equivalent balance of Horizon Limited is 70 million. So the ending cash and cash equivalent of Horizon Limited is 80 million. As discussed earlier, accounting principles provide the foundation on which the edifice of accounting standards is constructed. Accounting standards define the boundaries within which accounting policies may be chosen. The chosen accounting policies for its implementation calls for managerial estimation and judgment. For example, accrual principle is a foundational principle for the accounting standard for depreciation. In India, the accounting standard for depreciation provides for two options: written down value method and straight line method. If the firm chooses the accounting policy of straight line method, management will have to estimate the economic life of the asset to determine the depreciation charge. Accounting standards. It is important that information in financial statements is reliable and comparable over time and across firms. To ensure this, firms are required to conform to a set of accounting standards and principles. Globally, the US generally accept accounting principles called US GAAP, and the International Financial Reporting Standards called IFRS dominate. The International Financial Reporting Standards, or IFRS, set by the London-based International Accounting Standards Board, seek to harmonize financial reporting around the world. IFRS has been accepted by European Union and some 100 countries such as Australia, Canada, India and China have adopted or plan to do so. What is the difference between IFRS and US GAAP? IFRS tends to be principles based, which means there are no hard and fast codes to follow. US GAAP, by contrast, is rules based. there are thousands of pages of prescriptive regulatory guidance and interpretations from auditors and professional accounting groups. Indian accounting standards or INDAS are named and numbered in the same way as International Financial Reporting Standards or IFRS. INDAS is a carve out from IFRS. What is a carve out? A carve out is a divergence from the practices and principles as set out by the IFRS. India has chosen to converge with IFRS as opposed to adopting it. This gives the standard setters freedom to modify the standards to reflect local economic environment. National Financial Reporting Authority has been set up by Government of India. National Financial Reporting Authority or NFRA recommends accounting standards to the Ministry of Corporate Affairs. Ministry of Corporate Affairs spells out the accounting standards applicable to companies in India. There has been a paradigm shift in the economic environment in India in the last few decades, resulting in a lot of cross-border investment and financing. This has stimulated considerable interest in internationally acceptable accounting principles. Initiatives taken by International Organization for Securities Commission toward promoting international accounting standards and IFRS have had an important bearing on Indian accounting practice. Now we'll examine the balance sheet and statement of profit and loss of Hindustan Unilever Limited to get a flavor of real-life financial statements.
The assets of Hindustan Unilever are divided into two categories, non-current assets and current assets. Non-current assets are assets which have an economic life of more than 1 year. Current assets are assets which have an economic life of less than 1 year. The classification of non-current assets and current assets into different types is in conformity with the format given under the Companies Act. The most important items are property, plant and equipment, capital work in progress, which represents the capital assets which are under construction, goodwill and other intangible assets. Other intangible assets represent intangible long-term assets. In the case of Hindustan Unilever, these are assets like trademarks and patents. Financial assets comprise of investments, loans and other financial assets. Non-current tax assets and deferred tax assets require some explanation which will be offered in a short while. Under current assets, the most important assets are inventories, investments, trade receivables, bank balance, cash and other cash equivalents. When we add all of these, the total is 70,517 crores. Let us turn our attention to equity and liabilities. Equity consists of equity share capital and other equity. Other equity is also referred to as reserves and surplus. Other equity is 48,826 crores, whereas equity is just 235 crores. This is understandable because other equity represents accumulated retained earnings from the very inception of the firm. Liabilities are divided into two categories, non-current liabilities and current liabilities. Non-current liabilities are liabilities which are expected to mature after 1 year, and current liabilities are liabilities which are expected to mature within 1 year. The most important items here are other financial liabilities, non-current tax liabilities. If we look at current liabilities, we find that trade payables loom large. They account for nearly 9,068 crores. Hindustan Unilever gets a lot of credit from its suppliers and vendors. So this is the largest liability item on the balance sheet. The total of equity and liabilities is 70,517 crores, which is the same as the total of assets. The consolidated statement of profit and loss for Hindustan Unilever for the year ended 2022 is shown here. This statement shows the income, expenses and profit for the year. The important items are revenue from operations 52,446 crores, cost of materials consumed 16,446 crores, purchases of stock in trade 9,311 crores, employee benefit expenses 2,545 crores, depreciation and amortization expenses 1,091 crores, other expenses 11,309 crores, This includes selling and distribution expenses, R&D expenses, general administration expenses, and so on. Profit before exceptional items and tax 11,918 crores. Current tax 2,840 crores. Profit for the year 8,892 crores. There are notes to every item in the balance sheet as well as in the statement of P&L, and these notes provide all the details that you require to dig deeper into the financial statements of the firm. You have to consult these notes in order to get a deeper understanding of the financial statements.
There is a line item below the income statement called Other Comprehensive Income or OCI. OCI refers to items of income and expenses that are not recognized as a part of the profit loss account. It is gain or loss that has not been realized. Examples of OCI are unrealized gain or loss on bonds, unrealized gain or loss on investments, foreign currency translation gain or loss, pension plan gain or loss. For our purposes, OCI is not relevant. Let us look at the key accounting policies and practices followed by Indian companies. If you examine the financial statements of a number of companies in India, you find that these statements are prepared for a going concern in accordance with Indian accounting standards under the historical cost convention on an accrual basis and comply in all material aspects with the Companies Act 2013. Based on a perusal of financial statements of a number of companies in India, we can comment on accounting practices relating to current and non-current assets and liabilities, valuation of inventories, valuation of financial investments, revenue recognition, depreciation stroke amortization, research and development expenses, foreign currency transactions, employee benefit costs, taxes, provisions and contingencies, EPS or earnings per share. Assets and liabilities are classified as current or non-current on the basis of a cutoff period of 12 months. Valuation of inventories. Inventories are valued at cost or net realizable value, whichever is lower. The cost of finished goods and work in progress comprises raw materials, direct labor, and other direct costs and related production overheads. Net realizable value is the estimated selling price less the estimated cost of completion and the estimated cost necessary to make the sales. Investments that are readily realizable and are intended to be held for not more than 1 year from the date on which such investments are made are classified as current investments. All other investments are classified as long-term investments. Current investments are valued at cost or market value, whichever is lower, in conformity with the conservatism principle. Long-term investments are valued at cost. In case of decline in value, which is not temporary, the necessary provision has to be made. Revenue recognition. Revenue is recognized on transfer of significant risks and rewards to the customer, which takes place on dispatch of goods from the factory or port respectively. Depreciation stroke amortization. Tangible fixed assets except leasehold land are depreciated on the straight line method on a pro rata basis from the month in which the asset is put to use. Leasehold land is amortized over the period of lease. Depreciation. The useful life of an asset given in Companies Act 2013 is the basis for charging depreciation. Depreciation is charged in such a way that the residual value of the asset at the end of the useful life is equal to 5% of original cost. Two methods of depreciation are allowed under the Companies Act: straight line method and written down value method. Under the straight line method, the annual depreciation is equal to cost of the asset minus residual value divided by the life of the asset. The depreciation charge remains constant from year to year. Under the written down value method, depreciation charge is equal to a fixed percentage of the book value at the beginning of the year. As a result, depreciation charge declines from year to year. An example will show how the depreciation schedule is obtained under the written down value method. An asset costs 100,000 and the depreciation rate under the written down value method is 40%. The original cost of the asset is 100,000. The depreciation charge for the first year will be 40% of 100,000. So the depreciation charge is 40,000. The book value at the end of the year would be 100,000 minus 40,000, which is 60,000. When it comes to year 2, 40% of 60,000 is charged as depreciation. So the depreciation charge for year 2 is 24,000. After deducting this depreciation of 24,000 from 60,000, the book value at the end of year 2 would be 36,000, and 40% of that is 14,400, which represents the depreciation charge for year 3, so on and so forth. The rates of depreciation are also specified under the company law and income tax. It must be mentioned that under the Income Tax Act, only the written down value method is permitted. Under the Companies Act, the company has an option of choosing the straight line method or the written down value method. A very long schedule is given under both the legislation, so rates applicable to a wide range of assets. For the sake of illustration, I have given the rates for certain types of assets under Income Tax Act and for certain types of assets under company law under the straight line method as well as the written down value method. Research and development or R&D, companies make a distinction between revenue expenditure on R&D and capital expenditure on R&D. Revenue expenditure on R&D is typically charged against the profit for the year in which it is incurred. Capital expenditure on R&D is shown as an addition to fixed assets and depreciated accordingly. Some companies make a distinction between revenue expenditure on research and revenue expenditure on development. Revenue expenditure on research is expensed. Revenue expenditure on development is treated as a deferred revenue expenditure and expensed over a period of time. Research and development. Accountants distinguish between research and development. Research involves gaining new knowledge and understanding, such as searching for a new drug molecule. Development involves the application of research findings for the production of better materials, products, or processes, such as designing and testing a new drug. Foreign currency transactions. Foreign currency transactions are recorded at the exchange rate prevailing at the date of the transactions. Exchange differences arising on settlement of transactions are recognized as income or expense in the year in which they arise. Translation of foreign currency denominated assets and liabilities. An entity's foreign currency denominated assets and liabilities are translated into its functional currency using the following principles. 1. Monetary items are translated at the closing rate. 2. Non-monetary items measured at historical cost are translated at the transaction date rate. 3. Non-monetary items measured at fair value are translated at the valuation date rate. 4. Exchange differences are taken to the statement of profit and loss. They are shown in other comprehensive income. Employee benefit costs. Short-term employee benefit costs are recognized as an expense amount in the statement of profit and loss for the year in which the related service is rendered. Post-employment and other long-term employee benefit costs are determined on the basis of the kind of plan the company has. If the company has a defined contribution plan, whatever is the defined contribution annually is charged to the P&L for the year. If the company has a defined benefit plan, the liability on account of this plan is periodically determined on the basis of actuarial valuation, and charge is made to profit and loss account accordingly. Provisions and contingencies. Provisions are recognized when there is a present obligation as a result of a past event, and it is probable that an outflow of resources will be required to settle the obligation, and there is a reliable estimate amount of obligation. Contingent liabilities are disclosed where it is either not probable that an outflow of resources will be required to settle, or a reliable estimate of the amount cannot be made. The key difference between provisions and contingent liabilities is that provisions are recognized on financial statements and reflected on financial statements. Contingent liabilities are merely noted as footnotes and not directly reflected on financial statements. Taxes. Tax expense for the year comprising current tax and deferred tax is included in determining the net profit or loss for the year. Current tax is measured at the amount expected to be paid to the tax authorities in accordance with the Income Tax Act and the prevailing tax rates. Deferred tax is recognized for all timing differences. Let us understand the notion of deferred tax. Accounting profit often differs from taxable profit. Current income tax is payable on taxable profit. The difference between accounting profit and taxable profit may be permanent when a company enjoys some tax exemption, or temporary when depreciation charges are different for accounting and tax purposes. Permanent differences are not recognized in accounting. Temporary differences may result in future tax payable, in which case a deferred tax liability arises, or future tax benefit, in which case a deferred tax asset arises. A change in deferred tax liability is a deferred tax expense. A minus means reversal. To understand deferred tax expense and deferred tax liability, let us look at a stylized example. An asset costs rupees 100 million. It has a life of 2 years. The residual value is 0. The depreciation rate for tax purposes is 100%, and the method is written down value method. The depreciation rate for financial reporting is 50%, and the method is the straight line method. The tax rate applicable to the firm is 50%. The tax report for 2 years looks like this. Profit before depreciation tax is 100 million. Depreciation is 100 million in year 1. Depreciation is 0 in year 2. Taxable profit is 0. Tax is 0. Profit after tax is 0. In year 2, profit before depreciation taxes is 100 million. Depreciation is 0. Taxable profit is 100 million. Tax is 50 million. Profit after tax is 50 million. Let us look at the financial report. To prepare the financial report, we have to recognize that there will be a higher tax liability in year 2, and this has to be provided for in the form of deferred tax liability. So we have to create a deferred tax liability of 25 million in year 1 as a matter of prudence, because we know that there will be a higher tax liability in year 2. So the financial report looks like this. Year 1, profit before depreciation taxes 100 million. Depreciation as per straight line method 50 million. Profit before tax 50 million. Current tax is 0. This is pulled from this statement. Deferred tax is 25 million. We define deferred tax as change in deferred tax liability. To begin with, deferred tax liability was 0. We created a deferred tax liability of 25 million for future tax payable. So changes in deferred tax liability are 25 million, and this is reflected as deferred tax. So profit after tax is 25 million. When it comes to year 2, profit before depreciation tax is 100 million, depreciation 50 million, profit before tax 50 million. Current tax is now 50 million drawn from the tax report. As far as deferred tax is concerned, we know that in year 2 there is no deferred tax liability. So the change in deferred tax liability from 25 to 0 means minus 25. So this is shown here. Profit after tax is 25 million. Let us understand the concept of deferred tax asset with the help of an example. Company A gives a loan of rupees 500 crores to Company B, which is repayable after 2 years. At the end of year 1, Company A realizes that Company B may partially default on its obligations. So, as a matter of prudence, Company A makes a provision for bad debts in its financial report of 100 crore rupees. However, the income tax department will not take cognizance of a provision made by the company because income tax department allows a deduction only when the bad debt is written off, not when a provision is made. So if we compare the financial report with the tax return, we find that taxable profit will be higher by 100 crore rupees because for determining the taxable profit, the provision is not taken into account. Since the taxable profit is higher, the company has to pay taxes of 25 crore, assuming that the tax rate is 25%. Company A is, however, sure that at the end of year 2, it will write off 100 crore of bad debt, and when it writes off that bad debt of 100 crore at the end of year 2, its taxable profit on account of that write-off will decline by 100 crore, and on that write-off, it will get a tax rebate of 25 crore. So at the end of year 1, Company A creates what is called as a deferred tax asset of 25 crore. It is like saying that we will save potentially on taxes because the write-off, and hence we are showing a deferred tax asset of 25 crore rupees. Earnings per share. Basic earnings per share is equal to net profit or loss divided by weighted average number of equity shares outstanding during the year. For purpose of calculating diluted EPS, the net profit or loss for the period attributable to equity shareholders and the weighted average number of shares outstanding during the period are adjusted for the effects of all dilutive potential equity shares. There is a system of internal and external audit to ensure that financial statements represent a true and fair view of the financial affairs of the firm. Firms have an internal control system which is meant to ensure that at least two persons are involved in making payments. Internal audit examines all or substantial parts of the accounting transactions to ensure that the internal control system works effectively. Internal auditing may be done by full-time employees of the firm or independent accounting firms. Internal audit submits its report directly to the audit committee of the board. External audit or statutory audit is meant to ensure that accounting records and internal control systems of the firm are examined by an independent accounting firm. Earnings management or managing the bottom line is a common practice. Many firms use the latitude available to management in choosing accounting policies or making various estimates and judgments for moving the bottom line in the desired direction. Here are some of the ways by which companies manage the bottom line. 1. Inflate the sales for the current year by advancing the sales from the following year. If the current year looks very bleak, the firm may persuade its distributors to buy goods in the last month of the year with an understanding that they could return it in the following year. Essentially, the firm is trying to move income from the following year to the current year to alter the other income figure by playing with non-operational items. If the operating performance is anemic, the firm may resort to sale of assets where it can book profits, generate other income, and ensure that the final bottom line is reasonably healthy. 3. Fiddle with the method and rate of depreciation. Companies have freedom to choose the method and rate of depreciation. A company can shift from straight line method to written down value method and vice versa, and even alter its estimate of the economic life of the project to use this lever for managing the bottom line. 4. Capitalize certain expenses that are ordinarily written off. Expenses like market development expenses, manpower training expenses, and R&D expenses, which are ordinarily written off, may be capitalized or treated as deferred revenue expenditures so that the charge to the current year is lower than what it would otherwise have been. 5. Defer certain discretionary expenses to the following year. Expenses like R&D expenses, market development expenses, and manpower training expenses are discretionary expenses. If the current year is lackluster, the firm may defer these expenses to the following year. Essentially, the firm is moving expenses from the current year to the following year in order to project a favorable bottom line. 6. Delay commissioning of plants. No sooner a plant is commissioned, depreciation has to be charged. Further, interest on loans taken for setting up the plant can no longer be capitalized. So, there is a tendency to delay commissioning of plants if the current year's operating performance is poor. 7. Make inadequate provisions for liabilities. A company may have a trade receivable which is likely to turn bad, but it may not make adequate bad debt provision. This is largely within the discretion of management. 8. Make extra provisions during prosperous periods and write them back during lean periods. If the current performance is exceptionally good, the company may make extra provisions in order to have some kind of a cushion which can be used in future years when the performance may not be that good. 9. Revalue assets to create impression of reserves. If the company has valuable real estate and plant and machinery which are carried in the books at a low cost, it may revalue those assets upward, create revaluation reserves, and try to give an impression of greater financial strength. 10. Lengthen the accounting period in an attempt to cover poor performance. If all other levers of managing the bottom line fail, the company may extend its accounting year by 3 months, 6 months, or whatever in an attempt to cover poor performance. It has to offer a suitable explanation to its shareholders, but corporate managements have information advantage and they can use that information advantage to justify their actions. Why do firms manage the bottom line? There are three primary reasons. One, to project an image of low risk, to promote the perception that management is competent, to increase managerial compensation if the same is linked in some way to the bottom line. It must be recognized that financial statements are self-report cards. It is a natural human tendency to prepare a self-report card in such a way that one appears in a glowing light. How do we judge the quality of financial reporting? There are three criteria that one may employ to judge the quality of financial reporting. 1. Promptness. How promptly does management recognize a problem and report it to shareholders? 2. Candor in analyzing past performance. How candid is management in analyzing past performance and admitting failures? 3. Meaningful discussion of prospects. How meaningful is the discussion about the future prospects of the firm? The levers of earnings management can be divided into two broad categories: accruals management and management of real earnings. Accruals management. Since the accrual principle is used for accounting, management has to estimate the useful life of property, plant, and equipment, assess the fair value of investments, choose the method and rate of depreciation, make provisions for bad debt and pension liability. If management wants to boost the bottom line, it can follow very aggressive policies. If it wants to depress the bottom line, it can follow very conservative policies. When accruals management does not suffice, the firm may resort to real earnings management. The firm may use levers like the ones listed here. reduce discretionary expenses like R&D expenses, market development expenses, and manpower development expenses, offer discounts to boost sales at the end of the reporting period, sell surplus assets where gain can be booked, delay planned commissioning to reduce depreciation charges, defer capital expenditure to the following year, defer plant maintenance expense to the following year. We can summarize the previous discussion in the form of a simple equation. Accounting performance is equal to economic performance plus error plus bias. It is instructive to look at some high-profile accounting scandals. Enron saga. Enron was a highly prized company in the US in 1990s. It was admired for its innovative business model. Besides having an innovative business model, Enron was very creative in its accounting. Enron resorted to a lot of off-balance sheet transactions, inflated profits with the connivance of Arthur Andersen, its auditors. What did Enron really do? Enron awarded management consultancy contracts also to Arthur Andersen. Auditing is a low-paying, boring task. Management consultancy is a very paying and sexy activity. By awarding juicy management consultancy contracts to Arthur Andersen, Enron made Arthur Andersen very pliable. Arthur Andersen connived at all its accounting manipulation. Enron, given its high-profile image, could persuade SEC to accept those unconventional accounting treatments. A combination of dubious accounting practices and connivance by auditors and SEC enabled Enron to inflate profits for several years in succession. Finally, it's since caught up with it and it filed for bankruptcy, the largest ever bankruptcy in the US history. WorldCom, a telecom operator, resorted to capitalization of operating expenses to the extent of $4 billion. It inflated its operating profit. Its sins also were discovered and it too filed for bankruptcy. In India, we had the accounting scandal of Satyam. Satyam Computers was promoted by Ram Lingaraj, a poster boy of Indian IT sector. Apparently, the company did very well in initial years. Thereafter, the company resorted to accounting manipulation. It inflated revenues and created fictitious bank deposits. The accounting fraud remained undetected for several years. It's surprising that a year before the accounting fraud was detected, Satyam Computers won the Golden Peacock Award for corporate governance from the Institute of Chartered Accountants of India. The moral of the story is that if management is very creative in its fraudulent accounting policies, it can hoodwink auditors and remain undetected even by a competent board. Finally, the company had to be rescued by Government of India. They found a buyer in Tech Mahindra to revive the company. What are the characteristics of companies that indulge in accounting manipulation? Here are some of the common characteristics. The profit and loss account reflects a rosier picture compared to the cash flow statement. There are many group companies and related party transactions. Promoter shares are pledged. There are frequent changes in auditors, CFOs, and financial year endings. There are numerous M&A transactions and frequent fundraising. There are off-balance sheet liabilities. The company employs complex structures to avoid consolidating loss-making investments. There is a weak or less than ideal board comprising mainly of promoters, relatives, and friends. A key objective of financial statement analysis is to estimate future earnings from current earnings. Unfortunately, the profit in the annual report is a noisy measure of a company's operating performance. Earnings quality refers to the probability of earnings trends continuing and the extent to which earnings could represent distributable cash. Earnings quality. Earnings are deemed to be of high quality if they can be distributed in cash. if they are derived primarily from continuing operations, and if they're based on conservative accounting methods. On the other hand, earnings are deemed to be of low quality if they cannot be distributed in cash, if they're derived primarily from non-continuing operations, and if they're based on liberal accounting methods. Managers should understand four axioms of quality reporting. Incomplete information leads to uncertainty. Uncertainty increases the risk for investors. Higher risk for investors means investors demand a higher cost of capital. A higher cost of capital leads to lower security prices. So incomplete information eventually diminishes the value of the firm. Managers engaged in value creation must adhere to quality reporting. A major reason for accounting manipulation is that firms are required to present financial reports on an annual and now quarterly basis. As Warren Buffett observed, why should the time required by a planet called Earth to circle around the Sun synchronize with the period required for a business initiative or plan to bear fruit? Here are some suggestions for detecting the accounting time bombs. Read backwards. Read a company's financial report backwards. Normally, brighter things are reported in the front, and murkier and dirtier and bleaker things are reported at the back. So, read the report backwards. Read the notes. Notes to accounts provide a wealth of detail. Read more. Increase your financial literacy and accounting literacy by reading books like Financial Shenanigans by Howard Schilling. Ethics in finance, according to the Institute of Management Accountants, ethics deals with human conduct in relation to what is morally good or bad, right and wrong. It is the application of values to decision making. These values include honesty, fairness, responsibility, respect, and compassion. Everybody else is doing it is a phrase that is commonly encountered in business. Buffett has described it as the five most dangerous words in business. Many people think that if you comply with laws, your behavior is ethical. In a pluralistic society, law represents the baseline of norms on which there is societal agreement. The law is a crude instrument that trails rather than anticipates behavior. According to Lynn Payne, attention to law as an important source of managers' rights and responsibilities is integral to, but not a substitute for, the ethical point of view that is attentive to rights, responsibilities, relationships, opportunities to improve and enhance human well-being, moral virtue, and moral excellence. The cases of Enron, WorldCom, Satyam, and many other business scandals have highlighted ethical issues that pervade the world of business and finance. There are compelling arguments for bringing ethics to bear on financial decision making. One, no enduring, sustainable legal enterprise can be founded on unethical principles. Two, ethical behavior builds trust between the firm and its stakeholders, and this translates to more effective and economically beneficial transactions. Of course, ethical behavior should be viewed as an end in itself. 3. Ethical behavior builds stronger teams and leadership. 4. Ethical behavior will help managers to be the kind of people they want to be. They can live with a clear conscience, and that is paramount. Need for integrated reporting. For many companies, market to book ratio is 3, 4, or even more. This means a substantial part of market capitalization is not expressed as additives on the balance sheet. They reflect essentially non-financial factors. A company reporting just the accounting financial statement and sustainability leaves investors uninformed. So integrated reporting has started taking hold globally. International Integrated Reporting Council, headquartered in London, has provided the framework for integrated reporting. Integrated reporting in India. In 2017, SEBI recommended that the top 500 companies should consider the use of integrated reporting framework for annual reporting. In 2017, Reliance Industries, Tata Steel, Mahindra and Mahindra, Wipro and others began their integrated reporting journey. Subsequently, many more companies have joined the integrated reporting movement. Preliminary evidence suggests that both the companies and their stakeholders derive the following benefits from integrated reporting. Boards are assuming ownership of integrated reporting and articulating the value creation process. Companies are providing quantitative metrics and narratives about various capitals. An integrated report includes the following 8 content elements: organizational overview and external environment, governance, business model, risks and opportunities, strategy and resource allocation, performance, outlook, basis of preparation and presentation, general reporting guidance. The integrated reporting framework requires a firm to describe its value creation process in terms of a schematic diagram like this. On the left-hand side of this diagram are 6 forms of capital used as inputs: financial, manufactured, intellectual, human, social and relationship, and natural. On the right-hand side are the same 6 forms of capital expressed as the outcomes of the firm. In between is the business model, the firm describing business activities, outputs, risks and opportunities, governance, strategy and resource allocation, outlook and performance. We have covered a vast terrain. Let us summarize our discussion. 1. Finance is the lifeblood of business. Everything in business eventually boils down to the rupee sign. All managers require financial literacy. As a manager rises higher in the organization, he or she requires greater financial savvy. 2. Business entities are engines of wealth creation. An economy prospers if its business entities create wealth. An economy languishes if its business entities do not create wealth or destroy wealth. We have seen the sharp contrasts between the US and the USSR in the last 50, 60 years. The US has surged ahead economically because its business entities like Microsoft, Alphabet, Amazon, etc. have created enormous wealth, whereas Russia has lagged behind because its business entities have destroyed wealth. We have seen this phenomenon in India from 1990s onwards. The contribution of business entities like Reliance, TCS, ADFC has been enormous to the creation of wealth in this country. 3. Financial management is primarily focused on value creation in a legal, ethical, socially responsible, and environmentally sustainable manner. 4. The focus of this course is on 8 levers of value creation: strategy and business model, capital allocation, strategic financing, performance management, cost and innovation management, risk management, mergers, acquisitions and restructuring, and corporate governance. 5. The balance sheet shows the financial position of the firm at a given point of time. It reflects the assets of the firm, the liabilities of the firm, and the owner's equity in the firm. It is a stock statement. 6. The statement of profit and loss portrays the financial performance of the firm during a certain period, which is normally a period of 1 year. It shows the revenues, expenses, and the net results of operation. 7. The cash flow statement portrays the cash inflows and outflows of the firm in terms of operating activities, investment activities, and financing activities. 8. Financial statements are the products of the accounting system. The key ingredients of the accounting system are accounting principles, accounting standards, accounting policies, and management estimates and assumptions. 9. The most important principles of accounting are the dual aspect principle and the accrual principle. According to the dual aspect principle, assets are always equal to equity plus liabilities, irrespective of what the transaction is or what the transactions are. Assets are always equal to equity plus liabilities. The two sides of the balance sheet always balance. I often say accountants never die, they can only lose their balance. 11. There are 4 basic rules of accounting. As we have discussed, the accounting model is founded on 4 elementary rules of accounting. When I discovered these rules over 5 decades back, I realized how simple accounting is, at least in terms of its foundational principles and rules. 12. Financial reporting is different from tax reporting. When a company prepares reports for its shareholders, it wants to show that it has done well. There is a tendency to project a very favorable picture when management approaches shareholders. They want to grow before the shareholder that they have done very well. On the other hand, when a firm prepares its tax report, it wants to avail of all tax concessions and benefits. It wants to tell the tax department that it has done dismally. In other words, it wants to cry before the tax department. The motivations are very different. When the firm goes to shareholders, it wants to crow about its performance. When a firm goes to tax authorities, it wants to cry about its dismal performance. 13. Under Companies Act, two methods of depreciation are allowed, the straight line method and the written down value method. Under the Income Tax Act, only the written down value method is allowed. Under both the legislations, the rates are also specified. Of course, the rates are different under the two legislations. Under the Companies Act, the rates that are specified are the minimum rates. Under the Income Tax Act, the rates that are specified are the maximum rates. The whole idea is to counter managerial tendencies to inflate profits when it goes to shareholders and deflate profits when it goes to tax authorities. 14. Deferred tax asset and deferred tax liability arise on account of timing difference between financial reporting and tax reporting. 15. The common basis of preparation in India are going concern basis, historical cost basis, and accrual basis. 16. Assets and liabilities are classified into non-current and current. Non-current assets are assets which have an economic life of more than 1 year. Current assets are assets which have an economic life of less than 1 year. Similarly, non-current liabilities are liabilities which have a maturity of more than 1 year, and current liabilities are liabilities which have a maturity of less than 1 year. Revenue is recognized when there is a significant transfer of risk and reward. Depreciation is usually charged using the straight line method. 17. Current investment is carried at cost or market value, whichever is lower, in conformity with the conservatism principle. Research and development expenses are divided two categories: revenue expenses and capital expenses. Revenue expenses are written off in the year of incurrence. Capital expenses are added to the fixed assets of the firm. 18. The quality of earnings varies widely. We say earnings are of superior quality if they can be distributed in cash, if they will be sustained in future, and if they are calculated using conservative accounting policies. On the other hand, we say earnings are of inferior quality if they cannot be distributed in cash, if they cannot be sustained in future, and if they are calculated using very aggressive accounting policies. 19. There are several ways of managing the bottom line. Corporate managements have discretion in influencing the occurrence, measurement, and reporting of items in the financial statement. You must recognize that financial statements are self-report cards, so managements have a tendency to project themselves in a favorable light using the latitude available within the framework of accounting. 20. Knowing potential red flags is important for every user of financial statements. 21. Ethical principles are very important in finance. If you are interested in learning financial accounting in greater depth, here is my recommendation: Financial Accounting, a Managerial Perspective by Dr. R. Narayan Swamy. Thank you.